Hello, everybody. It's delightful to be able to talk to Share Stock again. City of London's just announced its 12-month results, which was the end of June. So I'll look back at the 12-month period and main changes we made in the highlights and the lowlights in terms of performance. And then I'll also talk about how the portfolio is positioned and how I'm seeing the markets today and what the outlook is like. So to start, just with a bit of background, I'm sure those of you as shareholders are familiar, but our objective is long-term growth in income and capital, and particularly through equities listed on London Stock Exchange. And we've obviously very proud of our dividend record, which is very important to our shareholders. And we've just achieved 59 years of consecutive increases in the dividend. One of the main attractions, or a key attraction of investment trusts, is having an independent board of directors, which City has had, and our chairman is Sir Laurie Magnus, and he's been chairman since October 2020. We're the largest UK equity income investment trust with some 2.3 billion assets as at 30th of June. I just want to point out to you two particular aspects of Sir Laurie's chairman's statement, which are very topical subjects in the investment trust sector. Firstly, is our share buyback policy. So City has issued a lot of shares over the years to new investors because we've consistently been standing on a small premium to NAV. So we've issued typically at a 2% premium, but we've also have been buying back at a 2% discount. And it's always been an aim of ours to keep the share price close to the NAV, which is means we have less volatility than most other investor trusts who don't have such a don't carry out buybacks like that. So we have bought back shares on a 2% discount, which also enhances NAV. And we've actually upgraded it from an aim to a policy. So it shows our commitment to do so. And over the last 15 years, we've rarely gone above a 3% premium or below a 3% discount. So I think that should be of reassurance to shareholders. And secondly, it's quite a fashion at the moment for investment trusts to be paying out their capital profits as dividends. And we've made very clear that we only think we would do that in very exceptional circumstances. It's highly unlikely. We believe in earning our dividend and paying it out of revenue. And we think these policies of paying capital profits out is quite untested in a bear market or downward market. It's fine when everything's going up, nobody really notices. But in the years when, say, the NAV goes down 10%, if you pay out another 2 to 3% of capital as dividends, it's going to aggravate the losses, and that we think it'll be very unpopular with shareholders in falling markets and indeed in flat markets. So let's move on to the next slide. Next slide, please, Pavlina. Thanks. So go back one, sorry. It's a bit of a delay. So I'm very proud to have been City's manager since 1991. So I've just clocked up 34 years. I worked very closely with David Smith, who I've worked with him for over 10 years. And he was appointed City's deputy fund manager 4 years ago. Our investment management fee is very competitive at only 0.30. So the board actually negotiated it down from 0.325 about 18 months ago. And that shows you the benefit of an independent board for shareholders. And our ongoing charge ratio, which is all our charges, is only 0.36, which is the lowest in our sector and one of the lowest across the whole investment trust sector. The 0.37 was 0.37 was the fee last year, and so it's only 0.36 now. And then we've got access to some very cheap long-term debt. So this is hugely to advantage for our shareholders: 30 million at 2.67% and 50 million at 2.94%. So this secures cheap debt for the next 25 years for our investors. Next slide, please. So David and I work as members of the Global Equity Income team at Janus Henderson, which you may know some of our colleagues, but we're a diverse team in terms of different experience. I'm obviously the oldest, but equally old with James Henderson. We're almost exactly the same age, but we've also got colleagues who are kind of mid-career and starting their careers. So we get a range of perspectives. Next slide. So Janus Henderson, it was a combination between Henderson, which was the UK firm, which I was originally working for, and Janus American, and we combined in 2017, and that's really worked very well in that Janus is mainly was based historically in the US, and that's been very helpful to our understanding of markets for us here in the UK. I think one thing I'd really highlight is that we have got some exceptional analysts who came in with the Janus merger, including our European banks analyst, who's been very helpful on the bank sector, and I'll talk about that shortly because that's been a big contributor to performance. Next slide. So in terms of the investment philosophy, it's valuation driven in the sense that share price value is critical for me, but I start with dividend yields, but I also look at a range of valuation factors, and I also look at the macro as well. If you're investing in an oil company, you've got to have a view on the oil price, for example. So we start with dividend yield, but we need to be in companies that are growing their dividends and growing their profits and investing enough for the future. So we're trying to avoid the high yield value traps. And you can see at the chart at the bottom that actually this is a study going back some 20 years, 24 years for the UK market, and the best returns have actually been in the kind of 2 to 4% dividend yield and 4 to 6% dividend yield range over this very long period. And that's where the bulk of Citi's portfolio is. Actually, the very lowest yielding shares, 0 to 2%. We have some of them in there for the growth potential, haven't actually produced such a good return as the middle range. And then the 6% plus yielders have also done less well than the middle range. Obviously, in that 6% plus, you sometimes get the value traps, you end up cutting their dividends. The other side of our approach is it's very conservative. We like companies that generate cash, they're best able to support dividends and the necessary capital expenditure. And we like strong balance sheets, especially for cyclical companies. So let's move on to the next slide. So now we'll look back at the performance, and the chart shows you the very long-term performance since I became manager in 91. You can see we're well ahead of the index. Performance is also strong over 1 year, where we're ahead of the index. We produced 16.8 against 11.2, and we're ahead of both the index and our investor trust sector and our OIT sector over 1, 3, 5, and 10 years. Our best performance relative performance tends to be in bear markets. We've historically been good at conserving shareholders' capital, but we've also had decent performance, in the rising markets we've had over the last year, as you can see. Next slide, please. This slide just shows you, which compliance are keen for me to show you, which just shows you the discrete annual performance over the last 5 years. Next slide. So just drilling down into our performance, which were the sectors which really helped? Well, the first sector is rather misleading, called investment banking brokerage service. I'd really call it financial services, and that was our best sector, followed by the tobacco sector, which came back into form over the year. They contributed, as did life insurance, and then being underweight, both pharmaceuticals and mining were also big positive contributors. Whilst the biggest attractor was aerospace and defense. We'll look at why that was in shortly, and then followed by electronic and electrical equipment, food producers, travel and leisure, where we were underweight, in a good year for travel and leisure. International consolidated airlines being particularly strong, British Airways owner, and then real estate investment trusts also detracted. Next slide. So in terms of the biggest single contributor, it was actually where we hold AstraZeneca. We're quite underweight, and it didn't have a great year, and so that was a big contributor to performance. That was followed by NatWest, which was a big positive contributor and also a very good dividend over the year. Imperial Brands, I mentioned tobacco as being a positive, and then BAE Systems, which is actually an aerospace stock, but what we didn't hold in aerospace was Rolls-Royce, which only actually started paying a dividend again at a very low level during the year. And so, although we benefited from having BAE, we detracted from not having Rolls, and that's why aerospace and defense detracted. And then M&G in financial services had a good year. So in pharmaceuticals, although we underweight AstraZeneca, we have got Merck of the US, which has done well in the long run, and but did detract as a whole sector had a difficult year. And then in banks, although we had NatWest, we didn't hold Standard Chartered underweight HSBC, so they were detractors. And then finally, Total Energies in oil detracted. Next slide. So talking about some of the portfolio activity, well, Direct Line was taken over by Aviva, which we already had. So we switched into Admiral, which has actually got, if anything, got a better record of motor insurance than Direct Line. We had some other takeovers in the portfolio. In addition to Direct Line, we had Britvic, which was taken over, and DS Smith. So we lost those two. In oil, we sold Eni, the Italian-based international oil company, and we bought Harbour Energy, which is a very interesting UK E&P stock, quite a small holding that we added to our holding in Shell. TPICAP is a kind of intermediary in financial markets, which we bought a new holding, good dividend stock. In utilities, we sold Pennon, the southwest of England water stock, but we've held on to Severn Trent in that sector. We also reduced SSE in electricity and utilities, but we kept a holding. And then two small consumer-facing stocks which had a difficult time and ended up passing their dividends were DFS Furniture and Burberry, and we sold those two as well. Next slide, please. So looking at the revenue picture, the dividend was up 3.4% for the 59th consecutive year. Earnings per share was up 3.3%. I'm pleased to say our revenue reserve per share was up 5.3%. And you can see our track record over the last 5 years. So if you go back to 2021, we were sort of coming out of all those dividend cuts from the pandemic, and we still had to dig into reserves that year by about 11.8%. But since then, we've covered the dividend in each of the following years. Next slide, please. So that chart on the left shows you the whole 59 years going back to 1966 of the dividend increase. I mean, the key is really having a core of consistent companies that can grow their dividends and grow their profits. And that's the critical thing. But we do have quite a diversified approach. As you can see that, if you look at where the income comes from by industry, consumer staples is 19.5%. And then a fair amount in financials if you added banks, financial services, and insurance together. But you can see that split out, it's a case of not having our eggs in one basket. Next slide. So a bit on the how I'm seeing the markets. Obviously, we are in a kind of new era of tariffs. I mean, you have to go back to the 1930s for tariffs to be of this level. I mean, the UK has a big services sector, so it's kind of relatively less affected in not having such a big manufacturing sector as some other countries. But it's probably a bit early to say, how it's all going to pan out with the tariffs. So it's I would say, heightened macroeconomic uncertainty. I mean, UK interest rates, we've had interest rates come down by 125 basis points to 4%. But there might be a pause now. I mean, inflation is ticking up. It is 3.8%, should get to 4%, and then head down again. But, obviously wage growth has proved quite sticky as well. So the Bank of England is treading cautiously, but I would expect interest rates to continue going down on a 12-month view. We think UK equities are terrific value. I mean, you've got a dividend yield of about 3.6%. You've also got a very large share buyback going on. Some 2% of the market cap of the FTSE is being bought back by companies. And so you've got a total distribution yield, which is dividend yield plus share buyback, over 5.5%, approaching 6%, which we think is very supportive. And the share buyback going on in the UK is bigger than you get in the US markets percentage of market cap. So you've got companies like we hold, like Imperial, Barrington, Shell, buying back so many shares they can grow their dividend, but it costs them less going forward because of the reduced share count despite the dividend growth. Citi's gearing is 5.3%. It's really mainly the fixed rate borrowings. We've got extra firepower if markets become better value. But looking at the sort of valuation charts, the PE is in line with the long-term average, the top chart, whilst the dividend yield is below what you get on 10-year gilts and 30-year gilts in the base rate. But we think that's more typical of how the relationship should be, because you get growth from equities, and so you would expect a lower yield. And the abnormal period was kind of from 2015 through to 22, when you had exceptionally low interest rates, which we don't see happening again in the foreseeable future. Next slide, please. So looking at the portfolio characteristics, we've got about 79 holdings, which is slightly down on where we were, say, a couple of years ago, 87, and we're predominantly in FTSE 100. We always will be largely in UK large cap stocks. We're 81%. We can be bigger in mid cap, but we're struggling to find stocks that meet our criteria in the mid caps. We're only 11%, and we've reduced the overseas listed holdings down from 17%, 3 years ago, now down to 8%, because we're seeing so much more value in the UK market. So our biggest sector weighting is banks, and this is quite a change. We've gone overweight banks. About 18 months ago, we went overweight banks the first time since before the financial crisis. And this is really work that our analysts did, which showed me that, and David, that they're called structural hedges. These are balances the banks have, which they tend to hedge out the UK banks on a 5 to 7 year view. And they previously hedged them when interest rates were ultra low. And as they roll over, they can hedge them, roll them over at much higher interest rates. That's been a very favorable tailwind to profits. At the same time, we think capital has been restored after many years to adequate levels in the banking sector. And if anything, the environment's becoming sort of almost less competitive for the banks, in that there's been some merger activity with Tesco's and Sainsbury's pulling out of banking and selling their operations to Barclays and NatWest. And so we think it's quite a good environment for the banks at the moment. We've seen some very good profits and dividend increases, so it's worked well. I mean, our largest holding is HSBC, though we are slightly underweight that one. It's a very big sector weight, but we are overweight NatWest, Lloyds, and Barclays of the domestic banks. So the second biggest sector weighting is financial services. That includes M&G as our biggest holding, but also includes our recent purchase of TP ICAP, but also 3i, which we've actually reduced a fair amount, taken some profits in 3i, but also companies such as St James's Place and Rathbones in that particular sector. Personal care, drug and grocery stores, that's really consumer staples. These are everyday goods. Unilever's very global, big presence in emerging markets. This sector also includes Tesco's, where we've got a big holding, and also Reckitt's. Oil's our fourth biggest sector. We're actually slightly underweight oil, but our biggest holding is Shell in that sector, which should be defensive with the big share buyback. And then tobacco's our fifth biggest sector, very cash generative sector, very good dividend stocks, and they're never going to be re-rate too much, but there's a huge share buyback going on in Imperial Brands, which has been very beneficial for those shareholders who are remaining. Next slide. So looking at the, if you drill down in our portfolio, at the underlying sales of our investee companies, some 40% are from UK, but the rest, 60%, is from overseas. And see quite a good split between the US, Europe, Asia Pacific, and emerging markets. And then the chart on the right just shows you where our weightings are, and our biggest overweight is in financials. And we've got about 33%, third of the portfolio in financials. That's banks, insurers, financial services, followed by consumer staples, where we have 18% of the portfolio. And where we're underweight is a kind of consumer discretionary area, which is retailers, leisure, hospitality. These are big employers are suffering a bit from the employers' national insurance increase. So we've only got about 2.5% in consumer discretionary, so pretty underweight. And we're fairly underweight healthcare as well, where there's a bit of uncertainty over drug pricing. Next slide. So looking at the top 10 holdings, and those numbers there are the percent of the portfolio. So the biggest single holding is HSBC. You got two really low yielders there, BAE and RELX, which are both in for RELX being the business information provider. They're very much in for their growth characteristics, and we think they're kind of big compounding growth stocks, and they've both done well, but we think there's more to go for. And then you've got, obviously, at the other end of the spectrum, BAT and Imperial Brands, which are yielding slightly more than 6%, and they're on the kind of high yield end. They're very much there for the income, although they've also produced some decent share price appreciation as well. And then kind of more in the middle of the pack are the banks. You've got you've now got three banks in the top 10, HSBC, NatWest and Lloyds, and they're kind of 4 to 5% yielders. And then the consumer staples stocks in the top 10, which are in Unilever and Tesco's, and they're in the kind of 3 to 4% yield band. Next slide. And then the next 10 down, you see a fair amount of financial services, life assurance there, M&G, Phoenix, Aviva, and legals all in that category. AstraZeneca is our biggest pharmaceutical, but we're quite underweight relative to the index. And then Barclays as well in banking. Our biggest utility is National Grid. Our biggest REIT is Land Security. That's an area we think is very interesting at the moment. The discount of almost 40%, yielding about 7%. We think it had a very good capital markets day yesterday, and they're seeing decent growth in rents in their big shopping centres. So we find it anomalous. I mean, it has been dragged down a bit by the gilt yield, but we think it's an attractive yield for sure. Dividend yield, that is. Rio is our biggest miner, and BP is our second biggest oil stock. So next slide. So to finish off, before I throw it open to questions, it's 59 years of annual dividend increases, the longest of any investment trust. We're immensely proud of that record. It's been achieved for consistent companies at the core of the portfolio, as well as using revenue reserves, when needed in serious downturns, such as during COVID. Lowest ongoing charges in the sector, even lower than last year at 0.36. And we've achieved long-term outperformance for our benchmark, which is the FTSE All-Share Index, through a conservative investment style. Thank you very much for listening to me, and I'd be very happy to take questions.
Thanks very much for that, Job. We have some questions. If anyone else would like to ask a question, can I remind you, just click the Q&A box at the bottom of your screen and you can type in your question. So we'll start with a question from Bob Meadows. Great record, Job. Thanks for that. How much longer do you expect to be running this trust for us?
Well, I've got no plans for retirement. I mean, I very much enjoy the job and I like the people I work with. So, obviously you've got your health to think about, but I'm sort of touch wood. I'm just going to carry on. I'm really enjoying it.
That's much appreciated. I'm sure your investors will be very pleased to hear that.
I should add though that David Smith, who I work with, I work with very closely, and if something was to happen to me, I've got every confidence in him.
So we have a succession plan, which is always important. Good, thank you. So I'll rephrase the next question from Rex. To what extent is the performance of the trust enhanced by the gearing that the trust has, and how would it have performed if you didn't have that gearing compared to the benchmark?
It's a good question. I mean, it made a small contribution to the performance over the last 12 months. And I think because it's so low cost, our gearing with an average coupon of that longer dated gearing of 2.8%, and which is £80 million worth. So, it's quite, if you can't beat 2.8% per annum, you might as well give up, but
you're in the wrong job, yes.
Obviously, our yield, our portfolio is above that, obviously, let alone any capital. But so it is a real advantage for our investors for sure. I mean, obviously, it can cut both ways. Gearing in a falling market will go against you, and we have a pretty cautious approach, as you can see. And as I mentioned, our gearing at the end of June was like 5.5%. So we're not kind of betting the farm on it all, but it's something that it's an advantage you have with an investment trust. It does in rising markets. It will help performance a bit.
I mean, am I right in thinking that the bond debentures you've issued, are they the only form of gearing that you use?
So yes, of the two I mentioned, £80 million worth, which is long dated, and we got a shorter dated. They're private notes actually, and we got a shorter dated note, which is just to 2029 at 4.53%. So that's also still quite cheap. And then and then we've got a bank facility with HSBC, which is £120 million facility. So that's more used for tactical. So if we get an opportunity, we can the moment it's drawn down by like 15 million or so, so it's pretty well unutilized. But if we get an opportunity, we can use that very easily. So that gives a lot of flexibility, the bank facility.
So from that, I gather that the total debt at the moment that's drawn is in the region of 100 million. Is that about right?
So the fixed rate borrowings are like 115 if you add on the 35 million
150.
shorter dated one, and then we've got probably another 15 million, or so it's probably about 130. So
130. Okay, it's still relatively small compared
yeah,
to the size of the trust.
yeah,
It's not going to have a huge effect on performance, but obviously, as you say, in a rising market, it does enhance it a bit.
yeah,
Thank you.
exactly.
Okay. Bob also comments that you only have about 1% exposure to technology, which in this era when technology is very fashionable seems quite low.
It's actually it's actually higher, and I tell you why, for a quirk, because Relics, which was a media stock, I mean,
Mm,
we can probably remember it's Reed Elsevier or Reed going
mm,
back.
mm,
One point there in the Daily Mirror a very long time ago, but they were originally a print-based business. They're now over 90% online, digital, and they've actually moved to technology sector. That's one of the biggest holdings. We've actually got about 5% in technology if you look at the end of June.
mm,
I mean, we only got one other tech stock, which is Sage, which has been really good software for accountants, and that's been in the portfolio for many years, and it's the only kind of real previously any UK technology stock in the FTSE. But it's obviously it's not a big area in the UK market, but we have
Not
about
quite. Yeah.
now Relics has been reclassified, and I have to say Relics, it's providing business information analytics to kind of the insurance industry, got commanding position, globally in that, and it's the number two in providing information to law firms, including America, and they're already using artificial intelligence in that division. They also are the number one in journals for scientists. So it's an incredibly strong company, and it also has a smaller exhibitions business, and it's we meet with chief executive probably twice a year roughly, and it's incredible the amount of R&D they're doing, constantly coming up with new products which improve and help their customers. So it's a really good company, and with a strong moat around it, and I think it's rightly classified now as a software company.
Yeah, as you pointed out, the basic problem is with your mandate being to invest principally in London listed companies. Sadly, there aren't many technology
Yes.
businesses in the UK market.
Obviously, we complement
Any size.
some, being in a technology trust, or
Yeah.
or a kind of, I mean, if you buy any global trust these days, given the index is dominated by big American technology companies, you're probably ending up with quite a big weighting towards technology.
Absolutely. Absolutely. Okay, thank you. Well, this is a very broad question from Tony, and rather a theoretical one, in that, it's a bit of a case of how long is a piece of string. But if the UK goes into recession, how much will your trust be impacted, do you think?
Well, I think obviously it would have an impact, but I mean, some 40% of the underlying sales of the companies are from overseas. So if the UK went
Mhm.
in isolation, obviously we got the 60% that is non-UK. But I think it's probably unlikely the UK would go into recession on its own. I would
Mm.
say, but I think the portfolio is fairly defensive and conservative. I mean, for example, those that chart of the sectors I showed you, I mean, consumer discretionary, which is sort of area which would be affected in a downturn. We've only got 2% as our biggest underweight category. So, we're underweight mining, which that's a global cyclical underweight oil. And we're overweight, consumer staples, kind of everyday products which people carry on buying. I think the financials, bits of it would suffer, bits of it might actually be all right. So I think obviously everyone would suffer if it was a global recession, but I think historically our portfolio has proved fairly defensive in downturns, as I said earlier. And we do focus on companies with strong balance sheets as well, which is important in a downturn. We don't like a combination of operational and financial gearing, because those companies are most likely to cut their dividends in a downturn. If you've got too much debt, as well as seeing a downturn in demand for your products and services, you've got to think about your bank manager first and end up cutting a dividend.
Yes, balance sheets are certainly important when considering what to invest in. Now, the next question is quite an interesting one, and possibly lets us expose a fallacy. So Sandy comments that the share price is at a record high. Does that mean it's a bad time to invest?
Well, no, I'm pleased our shares have just been at around the 500p level, which is very pleasing. But
Mhm.
if you take that view, then I mean, in stock markets in general, then you miss out massively, because stock markets kind of make a new high and then they carry on making. But ultimately, we will have another bear market at some point. It's absolutely no question about that. But it's trying to call it. It's incredibly difficult, and I think I mean, definitely people should only invest, in my opinion, in the stock market for the long run, because you don't know, you can't be sure what's going to happen the next day almost. But having said that, it's very difficult if you kind of come out of the market. It's very difficult to time your re-entry, and often private investors are best advised, in my opinion, to just stick with it for the long term. And certainly in difficult markets, the advantage of a trust like City London is that you will get a return from the dividend. Whilst if you've got a capital growth trust, which doesn't pay much for a dividend, then you've got no return at all. Whilst at least you'll get our quarterly dividend, which makes up for some short-term pain in the market, which you'll get from time to time.
Yes, worth mentioning as well that academic studies show that momentum is quite an important factor in successful investment. So often buying things when they're at their high can be quite a successful strategy. So it's difficult, as you say, that all good things come to an end at some point, but you can't really tell when. And just because something is at its high, that doesn't mean it's a bad time to buy. Thank you, Joe. Do you only invest in equity, or do you make use of options and any other forms of derivatives?
Well, we're going back. We have done some option writing, which is kind of selling out the money calls and puts, but which kind of can work in volatile markets, particularly on kind of lower yielding sectors, which we wouldn't normally get exposure to. But we haven't done it for over 10 years, and it can be a bit distracting in terms of particularly you might end up writing a call on a stock when you actually be better off selling the stock entirely. So we find it's better to focus on the dividends overall, but it's not, certainly there might be circumstances where it will be worth doing again. So it's not something we rule out. And going a long way back, we did have some fixed interest at one point. This was going a very long way back. So again, it's something we could do, but at the moment we're seeing better value in equities, really.
Thank you. Yes, I mean, writing call options is a way of enhancing your income, in theory at least. Good. Okay. Next question from Sandy. Is the trust also investing directly as a venture capital investor in scale-up businesses?
No, we don't. We're much more mature companies, to be honest. That's
Yeah.
I'm sure there are good trusts to do that, but that you wouldn't find that in us. No, that we're in kind of mainly in large quoted companies.
Yeah, I suppose part of the problem there is that you're a £2 billion trust, so it isn't really practical to invest in the smallest companies.
We did actually have we do have an investment which has been very successful in 3i, which of course invests in private companies, but their which has worked really well, but their portfolio is totally dominated now by Action, which is a discount retailer in Europe where they own most of it, and that's now over 70% of their NAV, and actually the shares gone to like 40% premium. So I've actually more than halved our holding in City. We've got a smallish holding. There's something wrong with Action's growing very rapidly, rolling out new branches across Europe, but it's it's just just the valuation is quite high, and so we've taken some good profits in that stock.
Yeah, it would seem a bit painful to be investing at such a premium to the value
Yes,
of its assets, even if they are growing.
it should grow into the. I mean, the theory is it
Mm.
should grow into the valuation, but
Yeah,
40% is quite steep.
it certainly is. Thanks. Okay. So the next question from Tom is, what do you expect the impact of all the buybacks that are going on to be on dividend distributions?
Well, this is one of the arguments, but we're finding in the vast majority of cases that companies are continuing to grow their dividends. I mean, okay, they might have grown them at a faster rate than but at the same time buying back shares. So we're seeing both. What's there's less of is special dividends, these one-off dividends, and I think companies, instead of doing a special dividend, are tending to buy back shares. But I think ordinary dividend growth, we see that continuing, and it's something we do ask our companies that we're happy we think particularly undervalued shares. I think share buybacks are very beneficial and sensible thing to do, but at the same time we don't want to be expensive growing the ordinary dividend. As I said earlier, as you shrink if you have fewer shares in issue, that means you can actually, the dividend becomes more affordable because you're paying it to less shares. So there's been a very virtuous circle on certain stocks like Imperial Brands and Shell, where they can the dividends kind of cost them less, even though they're growing it because of the share buybacks are so extensive.
Yes, I mean it can. If you pay out a fixed pound amount of dividends, if you can reduce the share count, then the dividend per share will rise, as you say. So that can be certainly beneficial. As you mentioned, it's key what price they're doing the buyback at,
Yes.
whether the shares are looking cheap, in which case the buyback makes sense. But companies that buy back shares that are already expensive, I'm not so
Yes.
keen on.
And also we think kind of one-off share buybacks don't really, it has to be done on a kind of consistent basis. I think one-off, it kind of gets lost in the ether a bit. I think that it's, so we encourage companies to do it as part of their distribution policy, but as on a kind of permanent basis. And I think that was very helpful to share price.
Thank you. Yes, good. Okay, so the next question, could you just explain to one of our delegates how the absence of holding a particular stock, such as Rolls-Royce, acts as a detractor from performance?
Yes. So say just make maths easy. Say Rolls-Royce is 5% of the index, and say it goes up by 50%, then if you hold it, you've kind of made a gain of 2.5% in the index. Whilst if you don't hold it, you don't get that 2.5% gain. So that's how you kind of would have detracted by 2.5%. So it's kind of in a way it's a slightly artificial thing. I agree, but and I think people can be too obsessed with relative performance against the index compared to whether you're actually making investors money or not. But I think it's something that people, they measure us to an extent against, how would we do if we were just in an index fund? I think that's probably with the growth of passive investing. So I think it is relevant, and we're proud that we have beaten the index over the long run and more recently as well. So it's a factor, and you can't be in everything, and Rolls-Royce did very badly and then has had a massive recovery, and it's done very well. But it's it hasn't paid. It's only just started paying a dividend again, as I mentioned. It's at pretty low levels, so it wouldn't have been one for us really.
Yeah, as you point out, it's really an issue of being a detractor relative to the index. So it's looking at the performance of your holdings relative to the performance of the index. Thank you. Okay, another question concerning the gearing. Why don't you deploy the available cheap long-term gearing to the maximum all the time to maximize returns?
So the cheap gearing is has been fully invested, and unless we felt the market was really expensive, will be it. And that, as I said, we consider strategic. I mean, it's more the bank facility, which we pay 125 basis points over base rate. So at the moment we're paying 5.25%. So it's kind of, it's expensive given the interest rates come down a bit recently, but it's not super cheap. And that one we use more tactically, and you've got to balance the obviously what the sort of likelihood of the market is going up against potential downside risk as well.
Yeah, thanks. And then another question: with long-term gilts yielding well over 5% and prices so depressed, would you not consider allocating some of the portfolio to lock in those yields and take advantage of the yield to maturity?
Well, obviously it was a different era. When I started in 1991, gilt yields were kind of like 8.5%. So it's obviously we were in a kind of different era for inflation then. So I don't think it's I mean, obviously, at fixed interest, you don't get any growth in the income by definition, true of gilts or corporate bonds. So, and we do want dividend growth from our investments, but it's I wouldn't rule it out, us investing in fixed interest. As I said, we have got the capabilities to do it and authority to do it, but at the moment, it's not quite sort of good enough value for me. I mean, I have to say, although the very long end's obviously been quite weak, actually spreads, that's the difference between the corporate bond yields and government bonds, are very tight at the moment. So you're not getting much of a premium, for going into an investment grade, high quality corporate bond over what you pay for the government. By standard history, it's very low, which shows the kind of optimism that's around in markets, but it's an interesting sign.
Yeah, thanks. And then finally from the delegates, Sandy is asking about a copy of the presentation. I believe we'll be making a copy available on our website in due course, as well as a recording of this presentation. So I believe delegates will be notified when it's available. And you can just look on our website under past events to find previous presentations. Okay, and we have one more from Rex. What is your view of equity markets in general? As he indicates, you've decided not to draw on your extra facilities. Is that a hint that you don't think they're cheap at the moment, presumably?
Yeah, they're not. I mean, those charts I showed you, the PEs and touch the long-term average. I think the yield's fine, given. I mean, I think the total distribution yield from the UK is pretty attractive, as I mentioned. The dividend yield and the share buybacks, kind of 5.5% to 6%. I think the UK, you look at on a like-for-like basis, you look at kind of UK stocks compared to ABC, look at Shell compared to, say, Exxon or Chevron, it's like a 35% discount, and go through various sectors, and it's the same. So, I'm very confident about UK equities. We see a lot of takeover activity, and that could well continue given given the amount of money out there in private equity, and also overseas companies looking to buy cheap UK stocks. So I think there's a lot positivity, but we have had a very good run in the face of kind of quite a difficult global geopolitical situation, to say the least. So I'm a kind of cautious investor, cautious personality. So you'd expect me to be conservative, but I'm a great believer in equities for the long run, as I've said. But I think it's I don't think it's a kind of bargain basement at the moment in the market, but we have got 5.5% gearing, and I'm very confident of Citi's portfolio.
Great. Then a couple more questions whilst we've got you, Job, if I may. Clearly, with a 2 billion plus portfolio, your exposure has to be mainly to larger companies. But I just wonder to what extent you do have exposure to FTSE 250 companies as well as the FTSE 100 ones.
Yes, we're about 11% in FTSE 250. I mean, we could get up up to about 20%. You know, if you get, historically, we've been as high as almost 20% going
Mhm.
back. I mean, at the moment, I'm finding it harder to find the kind of stocks which meet my criteria, particularly on, you know, the dividend yields
Mhm.
less good outside the FTSE
Mhm.
100, and the FTSE 250 tends to be more domestic and, you know, a
Mhm.
bit cautious about the domestic economy. So, you know, it's David Smith and I are looking around a lot in the mid 254 ideas and opportunities. We're very alive to the fact we could be big in our area. But having said that, City is always part of our definition in our objectives. We're predominantly in large cap companies. So, you know, obviously, if you want the mid cap and small cap exposure, there are other trusts to buy, you know,
Specialized
or
more in that.
rather than
Yes.
us.
Thank you. Then finally, you mentioned you were underweight miners and that had enhanced the performance over the last year. What about gold miners in particular? Obviously, the gold price has been going crazy.
Yeah.
Gold miners have been increasing their dividends. Some of them are
Yes.
looking more
I mean, the
attractive.
gold price has been absolutely phenomenal.
Yeah.
Yeah, and you know, you can obviously people kind of worried about currencies, and you know, gold is the ultimate store of value for some people. I mean, it doesn't have any yield gold as itself. So,
No, but the miners do.
but the miners, yeah, it's yeah, there's not really a big kind of presence in the UK stock market in gold mining stocks. So I haven't got any exposure to them at the moment. You know, it's difficult. I don't consider myself an expert on gold, to be honest, but I'm aware of how well it's done, and you know, certainly keep my eye out for opportunities. But it's sometimes you don't. It can be frustrating to make us, you know, when sometimes you don't actually make as much money in the mining stocks as you do in the underlying metal. You know, that can be a frustration that the shares
Yes, it
often
has
sometimes
been.
follow. You know, they can be gold mines quite difficult actually, and that you know they might have sort of production delays and issues, etc. So it's not an area I'm particularly expert on. It's not a big, say it's not really a big part of the UK stock. It's not even a small part of the UK stock market. It's really unfortunately.
Mhm. That's true. Though there's one uh, new addition to the FTSE 100 back from 2021. I think they joined Endeavour Mining, which has had a pretty phenomenal run and has been paying some nice returns and is buying back shares very heavily. So possibly some of your analysts might want to take a look at that one,
That's a
which
good.
has done very well for me.
That's a fair point. I'll have another look at it.
Okay. Thanks very much, Joe. That's been fantastic. It's been lovely
A
speaking to
pleasure.
you, and thanks for taking your time to answer all the questions. Oh, sorry, before I go, I think there's one more question. Stephen is just asking when the annual report will be published.
Very shortly. I mean, I think I don't know the exact answer, but we announced our results last Wednesday, I think it was. So I think the annual report should be out within the next few days.
Right. Thank you. Okay. Well, thanks very much once again.
Pleasure.
See you. Thank you. Bye for now. Bye, everyone.